Great. Ladies and gentlemen, we'll get started very, very soon. We're just going to wait 1 or 2 minutes as everyone virtually files in to today's webinar or seminar, and then we'll kick into it. As always, bit of housekeeping. If you do have any questions as we move through the webinar, please do drop them in the question box. Question box can generally be found on that GoToWebinar, little sort of pop-out box. And please do let us know if you can't hear us for any reason. You can drop a question there saying can't hear or comment or anything like that. And today's session will be recorded as well with the slides. So you'll see that coming out in the next 24 hours, but we'll get started. I'm just going to drop a comment in the chat for any of those late arrivees, just so everyone knows that everything's going to be recorded. So we'll kickstart very, very soon. Okay, as everyone comes in, just want to make sure you can hear us. So please feel free to raise a hand. You can usually do that on your GoToWebinar pop-out, or drop a comment in saying that you can hear us, just so we know that Jason and I aren't just having a conversation to each other for today. And then we'll kick into it. Thanks for that, guys. That's great. Good. Thank you. Beautiful. Okay, great. And just want to double check everyone can see the slides as well. You can drop a comment or put a question there as well, which is good. Yep. Great, thanks, Michael. That's great. It's coming up to 35 past. So why don't we jump into today's webinar and kick into it. So thanks for tuning in today. Expats, I want to say Australians and potentially US citizens and dual nationals as well, because you've all got the same problem sometimes dealing with the IRS, and that's why I've got our other host on today, Jason Stock. Today we're going to run through managing your finances as an Australian in the United States, or if you're, I suppose, a US expat in Australia. This is part 2. We've already hosted part 1 only what seemed like a week or 2 ago. The recording can be found on our YouTube channel, and you can also get a copy of the slides as well, but that's a really good starting point before jumping into today. We've got some leftover questions that we're going to jump into around that as well, which everyone might have just seen I had on a Word document before we kick-started it. If we just run through that housekeeping again, if you have any questions, drop them into that question box. And yes, confirming the recording will absolutely be going out to everyone that's registered. A quick disclaimer, what would a webinar be without a quick little legal disclaimer? And all it's saying today is that anything you see or hear today should not be taken as personal advice. Anything you hear or see today is for information, entertainment, and education purposes only. If you do require advice, please do seek some assistance from either a tax accountant, a tax lawyer, or a qualified or accredited US or Australian financial planner. Who is the Atlas Wealth Group? Well, we are a leading provider of Australian expat financial advice, tax, mortgage, and asset management services. We are regulated by ASIC, the ATO, and the DFSA. We have clients in over 45 countries, and all of our specialists are degree qualified with numerous postgraduate certifications. Who is Uptrend Advisory? They are the leading provider of US tax preparation services and tax advice for Australians in the US and Americans in Australia. They are regulated by the Chartered Accountants Australia and New Zealand, as well as US CPA. Team members are qualified with relevant degrees and certifications. Who are your panel hosts today? Well, as always, the good-looking rooster on the left-hand side there, Jason Stock, the US CPA and the Managing Director for Uptrend Advisory. I myself on the right-hand side, James Ridley. I'm the Managing Director here at the Atlas Wealth Group, and I mainly focus on the Asia Pacific and Americas region. Today's agenda, we're going to touch on a few different things, and it's mainly filling in the gaps of everything we didn't touch on in our last session. We're going to talk about options, ISOs versus NSOs. It's a really common one that a lot of expats receive whilst they're in the US, depending on the employer. Social Security, superannuation, and managing foreign currency. Exiting the US, that's a really big talking one, depending on your circumstances. US retirement accounts, a good holistic view there, as well as lastly, US tax compliance. And then we'll jump in to some Q&A at the end. I'll now hand it over to Jason to walk us through options, ISOs versus NSOs. Jason, you just let me know when to head over to the next slide.
Thanks, James. Thank you. Yes, please head on over to the next slide. Perfect. So incentive stock options or ISOs and non-qualified stock options or NSOs are what employers may offer employees as an incentive to stay at the company, similar to cash bonuses or RSUs. It can lead to large wealth creation events, so it's generally seen as a great thing. Both options allow the employee to purchase stock in the company at lower than fair market cost, which makes them attractive, but there are clear pros and cons to both types of options. So looking at ISOs first, the ISOs have some pretty clear pros. The one is the tax treatment where, if the certain requirements are met for holding it, the difference between the exercise price, as in what you bought them for, and the fair market value at the stock at the time of exercise, it can be taxed as long-term capital gains rates, which are generally lower than marginal tax rates. There's the tax deferral element where employees can defer taxes until they sell the stock, providing tax savings and cash flow benefits. There's no withholding forced upon the employee by their employer when exercising ISOs, which gives the employees more control over their tax planning. There are some cons though with ISOs, and one is the qualification rules. There's very specific statutory requirements and limitations on the exercise price, vesting period, number of options exercisable in any calendar year, so it is pretty restricted. The biggest one is AMT, which is alternative minimum tax, as the disadvantage. Exercising ISOs will trigger an AMT calculation, which is essentially a parallel what-if calculation compared to how tax is normally calculated, which can create an additional tax liability. The calculations are quite complex and can lead to unexpected tax bills if you have not planned for this accordingly. The next one's transferability, where you can't generally transfer ISOs, so you can't sell them, gift them, or transfer them, which is a pretty big deal. The last con of it is the expiration, in that they do have a limited exercise window, which is typically 10 years from the grant date. And then if it's not exercised during that period, the options become worthless. So that's ISOs. Moving on to NSOs. The pros of NSOs are that there's very broad eligibility for it. So they can be granted to employees, consultants, contractors, non-employee directors, which provide more flexibility in the compensation strategies that are offered to employees. Unlike ISOs, NSOs do not have to comply with those same statutory requirements that I was referring to, which give companies more flexibility in designing all of their option plans to attract and retain employees. There's no AMT with NSOs, which is a big delta and a big pro. And the other pro is that there's lower possible potential risk, since NSOs are subject to ordinary income tax rates when you exercise them. There's no risk of AMT liability or disqualifying dispositions. Moving on to the cons of NSOs, the tax treatment is less favorable in that when you exercise the NSOs, they are subject to ordinary income tax, potentially resulting in higher tax liabilities compared to ISOs, especially if the stock has appreciated significantly. There's no tax deferral when you exercise them, so it's an immediate cash flow implication for employees. There's no long-term capital gain treatment because it's always going to be treated as ordinary income. And then the last one's withholding at exercise. So similar to restricted stock units, employers are required to withhold taxes at the time of the NSO exercise, reducing the employee's ability to control tax planning, cash flow, and also causing a possible tax shortfall at tax time. That's it on ISOs versus NSOs. Over to you, James.
Great, thank you, Jason. And the tax planning one is such a huge one there, especially when you're getting to the end of the calendar year. And Jason sees it time and time again where there's been a lack of planning or consideration for, say, new clients, and they've already gone ahead and maybe they've done a cashless exercise and then they've taken the sort of proceeds and they've gone and used them for something else, spent them when they've got still a big tax bill coming. So that's a really important one to consider. Do some planning when you are going to exercise and what it all looks like. I know I send Jason quite a few people to run through that with him. So that's a really good one. Social Security, superannuation, and managing foreign currency risk. I wanted to talk about these. I mean, the first two center around a lot for retirement planning and foreign currency risk. I mean, it's what you have to deal with day in and day out when you're an expat. Some tough decisions to make, especially where you are going to end up long term. Let's talk about Social Security, because I just think Social Security is this amazing benefit that you can get access to as an expat when you've done the minimum time working over there. So right now, regardless of whether you're on an E3, I guess a green card or a US citizen, you can actually accrue enough benefits or credits to actually be eligible to claim on Social Security later in life. So right now, the minimum standard is getting at least 40 credits. You know, you need at least 10 years worth of work in the US to qualify for that retirement benefit. The amount of benefit is based on your highest 35 years of earnings. So naturally, if you're only getting 10 years in, then you'll have definitely an amount that's, I guess, owed to you as a monthly benefit when you do retire. But if you had 20 or 25 or 35 years, your monthly benefit until you pass away is a lot higher. I've seen some, and especially some of my clients, where they're getting 5,000 to 7,000 US per month. It is, I guess, a lifetime income stream technically. And when the currency is very strong, the US dollar is very strong, the Australian dollar is very weak, God, it becomes an incredible income supplement for their retirement. It is available from age 62, full retirement age, or I suppose benefits at age 67, monthly benefit index. The longer that you can wait to actually draw down on Social Security, the better the benefit. It'll be a lot larger on a monthly basis, and indexation of late to that has been about 6.8%. So it's benefited from quite high indexation over the last couple of years, but it is this terrific benefit, and it's just something that can't be overlooked. And I guess the next question that I often get is, well, how is it actually taxed in Australia by the ATO? It's a great question. It isn't. Plain and simple. So it's probably the one good thing that's come out of our treaty, to be honest, because there isn't many. But when we look at how it's taxed by the ATO, it isn't. It is actually tax exempt, not something you need to declare in your Australian tax return. It will still be subject to tax in the US as normal, that's fine. But the Social Security benefit is not taxed. The other key aspect of Social Security, I guess our comparison in Australia to Social Security is our age pension. But our age pension in Australia is assets tested and income tested. So a lot of Australians won't qualify for it. And I guess the maximum benefit you can usually get is around about 22,000, 23,000 a year. So it's not much to actually live off. But when you look at, I guess, Social Security, it is an asset tested, it is an income tested. It's actually based off everything that you've put into the system from a tax aspect over a minimum of 10 years. So that's where the big differentiator is. And then lastly, it's just not taxed in Australia. So it does provide a terrific income supplement. And I think there'd be a lot of, I reckon, Australians, which might have been in the US for a very long time, come back and probably forgot about the fact that they've paid into that social security system for a very long time and that they might be owed retirement benefits from age 62. So just one of those things to take note of. And I mean, the toughest part is actually claiming on it later in life, especially if you've forgotten about it, getting the paperwork, getting your old social security number together and dealing with the Department of Social Services. Australian super. Let's talk about it briefly. Jason actually did talk about superannuation on our last session. So if you want to do or want to play catch up a little bit on that one, I do recommend you jump into that because there is some, I suppose, different types of treatment around super and I guess the different structures, especially back in Australia. You know, you've got retail super funds, you've then got self-managed super funds, all different types of treatment. If we're a US citizen that's retiring in Australia, well, generally, contributions that you're putting into super are accessible. And then one thing that you can risk there is foreign grantor treatment or foreign grantor trust treatment. If you want to learn more about that, jump into the previous session because that can open up a whole another section of reporting requirements, PFIC risks, all those sort of things. You can still draw down from super in retirement if you're a US citizen retiring in Australia. It's tax-free in Australia, the income stream that you actually draw from Australian super, once it's in what we call an account-based pension. However, that income stream would technically be accessible in the US. So there's no, I guess the biggest item that we see there is because it's tax-free in Australia and it might be taxable in the US, there's no foreign tax credit that can be used because technically we don't pay any tax here on our account-based pensions. Most common scenario for US citizens that are retiring in Australia is they'll be drawing down a combination of their superannuation benefits, maybe some from their 401k or their US retirement assets, and then also getting maybe that social security benefit as well. So their, I guess, retirement or their income streams will technically be three-layered. You've got the super side, US retirement side, and then also the social security side. Australian citizens, say on a temporary US visa, I think the most common one would be E3 that we all hear about. Renounce US citizenship or turned in a green card, well, super actually becomes one of your greatest retirement assets. Absolutely. Maximum tax rate of 15%, long-term capital gains only 10%, and then once you're retired and drawing an account-based pension, all tax-free income, capital growth tax-free. That's when we see franking credits really getting refunded to your individual super accounts. That's when it all adds up. Tax-free withdrawals at age 60. So 60 is generally the minimum preservation age, access age in Australia. 65 is technically the retirement age, where you can still be working, but you can pull out anything out of the super then, and no sort of withdrawal requirements generally. Managing currency risk. Let's talk about it because it's a really common one. One thing that we communicate to our clients is if you do have an intention of retiring back in Australia, then a large portion of your wealth should still be accumulated in Australian dollars. And it might be accumulated across a few different buckets, you know, maybe some property, investments such as shares, and then maybe in retirement accounts as well. But naturally, you will have some US assets. That absolutely makes sense. We do recommend that you avoid the end of period approach or the last minute transfer. So all that means is if you've been in the US for the last 5, 10, 15, 25 years, you built up all your assets in the US dollar, and now you're going to start transferring it back. Well, we would say that that's not a successful repatriation because you can't control what the FX rate is going to be doing then, and neither can we. And therefore, you're better off taking that dollar cost averaging approach, breaking it up, a few transfers per year, putting in different assets that are going to keep growing your wealth, keeping up or outperforming indexation especially, and getting that benefit of the compounding effect. But when we look at the currency rate over the last 20 years, we have seen the Australian dollar at parity, or on the other side of parity. We've seen it go up to, I think the worst was about $1.07 in the last 20 years, and then we've also seen it down 58 cents through COVID times. Generally, I would say the happy medium is going to be sort of between 71 to 76 cents. I feel like that's its usual cushion level, its pain point. Right now, when we look at dollar cost averaging and what that means, well, it means, I suppose, means a lot of things to, I suppose, a lot of different clients, but it might mean monthly transfers, might mean quarterly transfers, semi-annual. One thing which is often the case with expats, when they first head overseas, they might not know if they are going to stay there long term. And it's sort of a case where you're wondering, well, what's the best approach? Probably the best approach in those times when you're unsure is doing a little bit both. You're diversifying, you're taking a very important hedge to managing currency by doing both. And then as time goes on and your plans firm up, then you can start to, I suppose, over leverage or overweight the way that you're now going to transfer your assets around or manage your assets, whether in the US or Australia. That's it for me in terms of those slides. I'm now going to hand it back to Jason to run us through exiting the US, a really good one. Let us know when to hit that next slide.
Thank you. Yes, please, next slide, James. So this one's a big one for a lot of people as they get through different phases of their life and they look to leave the US or leave the US tax system. So when planning, the exit from the US tax system, the first thing is it's going to be driven by your visa. So if you're a green card holder or a US citizen and are going to revoke citizenship or relinquish your green card, the exit planning will be the most complex because you have to manage the exit tax considerations tied to those two things under what's known as the Hart Act. But if you do not have a green card or citizenship, then it is just about managing your exit around the substantial presence test so that you can cease US tax residency by leaving at a certain point in the year to no longer pass the substantial presence test. So the main delta, we did cover it last session as well, but the main delta by switching from a resident to a non-resident is that as soon as you're a non-resident, you are only going to be taxed on US sourced income. Everything non-US is out of scope from that point forward. So that's great for a lot of reasons when going back to Australia. If you hold shares on US platforms or have bank accounts, as long as those institutions support non-residents, you would need to notify them of that. You can continue to hold those assets, but then you're going to be subject to the withholding tax on those income streams, dividends, interest, that the IRS at least gets something. There are strategies around avoiding US capital gains tax from selling shares on US platforms once you have ceased tax residency, but it is going to be case by case and institution by institution. There are then considerations around selling property, either Australian property or US property, before relocating or after relocating, depending on what your long-term strategy is and what your financial advisor has recommended for you. There can be favorable capital gains tax outcomes of waiting to sell an Australian property until you resume Australian tax residency again, as opposed to selling as a non-resident. And then scenarios where selling your US property before moving back to Australia may make more sense so that the US property CGT does not get caught in the Australian tax system either. As with retirement accounts, James is going to be covering their treatments in detail, but there is also a timing consideration as to when to withdraw from them, prior to relocating back to Australia, after relocating in a low income year for Australia, staggering it over multiple years, waiting until retirement age and more. So the timing of your relocation, when it comes to the physical relocation by the US calendar year versus the Australian financial year is all going to vary based on your life circumstances. Maybe there are some things forcing you to leave at a certain time, or what your work situation is like, such as continuing to work remotely as a possibility or ending it at a set date, and then what assets you have in either country. you should really, really work with a financial planner like James and an accountant to time what you move, when you move, in what order to minimize your overall tax burden between Australia and the US. As I'm hoping you can read between the lines that this is really, really customized and based on the individual's fact set. There's no black and white answer. Um, the last one, taxable Australian property and cost basis. So with shares that were not taxable Australian property while you're not living in Australia, they become taxable Australian property once you resume Australian tax residency, which creates a nice cost basis step up on those assets for Australian tax purposes, as well as resetting the cost basis for those assets that were previously deemed disposed, which James caught on the last webinar as well. So those things would help minimize the capital gains tax events for selling those shares from that point moving forward. I think that's everything that I can cover in this general sense based on these kinds of considerations, but hopefully that's helpful, and hopefully that shows people that are listening that you kind of need to plan this thing out quite intentionally. So over to you, James, for the retirement accounts.
Absolutely. And I mean, in terms of US retirement accounts, I just wanted to touch on the nuts and bolts. Generally 401ks, IRAs as a whole, a little bit on the Roths and what the nasty surprise can be for some Australian expats around a Roth, just because I still think it's a bit of an unknown, very different to how our Australian superannuation system is run with our employers. So let's jump into it around the US retirement account. So traditional 401ks, they're not offered to everyone. It really just depends on your employer. I think most common types I would see that don't get a 401k with a strong matching scheme is when you're working for a startup. And the main reason for that is cash flow. Startups don't want to spend too much money on those sort of types of things. They want to focus it back in the business, but they might over leverage or overweight a lot of your stock incentives, as Jason was talking about earlier, the ISOs, the NSOs, those sort of offerings, because it's something that they're not having to put down cash for, but something that sort of, I guess, ties you to the company. The golden handcuffs, I guess, is a good way to put it. When we look at a traditional 401k, yep, employer sponsored, employer may provide some sort of contribution matching scheme up to a certain percentage. Employees, they choose the investments. If you don't choose an investment, usually you put in some sort of life cycle mutual fund over in the US. In Australia, we call it a managed fund, but life cycle mutual fund, mutual in the US, and bears investment risk. The tax is deferred. So if it's a normal 401k, the contributions that are going in, they've actually never had any tax paid to the IRS on them. Those investments then grow, and then when you look to withdraw in the future, that's when you're paying tax to the IRS at your ordinary US tax rates. We can see there that if you do withdraw the benefits early, penalty tax of 10% for withdrawals before age 59 and a half. So technically you can actually withdraw from a 401k, which means very different to the Australian superannuation system, which legislation is very tight, very hard to get access to your super. So when we look at a 401k, you can draw down on it. If you're in the US, you're going to cop your 10% penalty tax on top of your US marginal tax rate. If you're in a state which has no issues with taxing you, then the tax that you're paying on that kind of withdrawal could be significant, and that's why timing is a very big factor. And that's what Jason was getting on about before in terms of, it's really important to plan when you are going to make these kind of withdrawals. I put in brackets there the rule of 55. Something which still is a bit of an unknown. A few US financial planners have actually forgotten about it that I've dealt with in the past. But when you leave your employer and you are 55 or older, that actually allows you the ability to access your 401k without copping the 10% penalty tax. It doesn't apply to a Roth. It's only a traditional 401k or IRA that you have with the employer. So essentially there's cessation there with the employer at 55 or older, and you can actually access your 401k without copping that 10% penalty tax on top of your US marginal tax rate. It says annual contribution limits apply, which usually index each year. A Roth, not as common, a Roth 401k, employer sponsored, after tax contributions going into that account. And then it's growing in, I guess, a tax-free environment. And then later, if you're doing a qualified withdrawal or distribution from the account, it's then also tax-free. So they can be beneficial. The contribution limits are a lot less, but I'll jump into, I guess, why we caution some of our clients to be mindful of going large on Roths very soon. Early penalty tax of 10% for withdrawals before age 59 and a half. The rule of 55 does not apply, so just re-emphasizing that. An IRA or individual retirement account, this is sort of, I guess, just a traditional account in the US, much like me going up and opening up my own super fund somewhere and doing something with it. Not employer sponsored at all. Earnings accumulate tax deferred, so very similar to just a traditional 401k. You're taxed on the withdrawal. There can be early penalty tax, much like the 401ks, and that is the exact same percentage there, 10%. You can't apply the rule of 55 to a traditional IRA because it's not linked to an employer. When we look at a Roth, similar, not employer sponsored, it's after tax contributions going in, it grows tax free, and then you need to make sure you're withdrawing it at the right age, such as 59 and a half. 59 and a half is probably the equivalent of Australia's preservation age, age 60. So that's where that all is coming from. And then same again, annual contribution limits do apply. If we look at how these types of accounts are taxed, very different on the Australian side versus the US side. So let's jump into it. I guess first and foremost, the tax applicable at time of withdrawal will be dictated by your tax residency status. Absolutely. So whether you're just a US tax resident, whether you're just an Australian tax resident, or unfortunately, if you're a dual. And that's not a bad thing at all, because foreign tax credits and all those sort of things, but it just means you'll have to include on both returns. Just want to emphasize I'm not putting shit on dual nationals. When we look at Australian tax residents, so if you're residing in Australia and you're withdrawing from a 401k, in Australia, it's deemed to be a distribution from a foreign trust. And that's the legislation just there, Section 99B of the Income Tax Administration Act, 1936, very boring. But the contributions that you've made and your employer make, they actually make up what we call the corpus of that trust. So they're the original capital. So you won't pay tax to the ATO on that component of your 401k or IRA or Roth, but the growth, that is taxable by the ATO. So it does mean that when you're drawing, an amount of 30 or 40,000 from a 401k and you're an Australian tax resident, only a portion of that income will be taxable by the ATO. So that's a really important one. It's really important to seek tax advice around that. On the US side, remember, in this case, we are not in the US, we are just in Australia, an Australian tax resident, so we are a non-resident alien. So 30% withholding tax in the US, that's usually typical, which is just the non-resident alien tax. You can request for withholding tax to be disregarded with a W8 Ben form. Unfortunately, it is hit and miss which 401k platforms will acknowledge such a form because the onus is on them to actually withhold. And sometimes we've seen where W8 ban forms have actually been applied, but the platform has actually still withheld 30%, regardless of us ticking every relevant box with your client, seeking the appropriate tax advice, but the platform has still withheld the 30%. Sometimes if they are withholding 30%, they can actually be withholding too much tax based on that withdrawal. Therefore, you are incentivized to lodge a non-resident alien US tax return because you might be entitled to a bit of a withholding tax refund because they've withheld too much. A Roth, be careful of a Roth. That's a good reminder for me. So the Roths, they are actually a really good retirement vehicle, but if you're going to be returning back to Australia and retiring, just remember that you've contributed to these types of retirement accounts using after-tax contributions. Unfortunately, the ATO does not treat this as a Roth account. The withdrawal should be tax-free. Absolutely not. The ATO just sees it exactly the same as a traditional 401k, which means you are going to be paying normal tax to the ATO on the growth component, which means you are actually double taxed. And I've crunched the numbers before for a few clients where their average tax rate based on contributing amounts to the after-tax environment was something like 45, one client was 55% based on the hypothetical we run. So they're not that great if you are going to be retiring back in Australia and you can't withdraw them before you leave the US, which typically is 59.5. So I don't really highly recommend Roths unless my client is going to be retiring in the US or they can withdraw it before they leave the US. So that's a really important one. Roths aren't that powerful if you are going to be returning to Australia and I suppose retiring in Australia. When we look at the other side and I guess the other scenarios that can come about, if we're a US tax resident living in the US citizen, green card holder, earnings plus deductible contributions taxed as ordinary income by the IRS in the year that received. So if we are retired in the US tax resident, and we're drawing a lump sum or an income stream from our 401k or our traditional IRA, it's just treated as ordinary income. So you'll pay your US marginal tax rates. There's no, I suppose, distinguishment between the contributions being capital or anything like that. So it's treated very differently to the way the ATO does. It's just treated as ordinary income. When we look at a dual US and Australian resident, well, on the US side, earnings and deductible contributions taxed as ordinary income by the IRS in the year it's received. And then on the Australian side, Section 99B. So, I mean, we're just condensing now both sides. Gross still accessible with the Australian Tax Office. However, you will be able to apply a foreign tax credit normally. The foreign tax credit is essentially the tax that you've had withheld or you've paid on the US side, and that's why we do have that DTA, a double taxation agreement in place. But remember, the ATO is saying you only have to pay tax on the gross component. So if, let's say that you've, as an example, you've had, we'll just do it clean and simple. You've had a withdrawal of 30,000, you've had 10,000 withdrawn on the US side. Because on the Australian side, only a portion of that income is accessible, you're not going to get the ability to use that full $10,000 as a foreign tax credit. Your accountant will have to pro-rata that down because you won't get the full benefit there. It's much like Social Security. Social Security isn't accessible here in Australia, so any tax that you're paying to the IRS on that income stream, you're not going to get here in Australia as a foreign tax credit because it's not accessible, plain and simple. That's it for me today. I'm going to hand it back over to Jason to run through the US tax compliance side. Let me know when to flick over, Jason.
Thanks, James. Thanks. Yeah, all very valid, very important things, especially with the Roth. A lot of people do not know about that and have quite a surprise that they've been contributing to it for all of these years and paying tax as you go, for suddenly Australia to just have that kind of view on it. If you can move to the next slide, please. This one's a big one, US tax compliance. This is one of the topics that comes up quite often. Every single year I have this conversation with new clients that, you know, unfortunately there are situations where they have, you know, the taxpayer has learned that they have not been compliant with all of their US tax reporting to date due to a few common reasons. The common ones are, you know, self-filing through a software like TurboTax, which is essentially a user-driven data entry module requiring you to know what you need to do, and it does not always contain all of the forms. Another one is filing through a local accountant who does not have international expertise and therefore isn't aware of foreign reporting requirements, which means that they're not reported at all. You as the taxpayer not knowing about worldwide income, asset, and structure reporting requirements. And the worst of all is just not knowing that they had to file. So if you as a taxpayer have not declared all worldwide income, assets, structures on your returns, you could be subject to very punitive fines to the tune of $10,000 per form per year minimum if caught. I say minimum as that is just the starting point and the IRS can escalate to larger sums. For those reasons alone, it is really, really important to complete your returns accurately. There can also be lost opportunities by not doing this either, whereby you're not optimizing things and you're not claiming foreign tax credits because you don't know that you can claim those credits. So depending on the scope of what's missing and the why, which is most important, why it was not done correctly, the IRS does have several amnesty programs that you can go through to get back into compliance. They're named on this slide: the streamlined domestic or streamlined foreign offshore procedures, the delinquent international information submission procedures, delinquent FBAR procedures, and if appropriate, just amending returns via normal means, which you can do. They all carry different pros and cons and are all kind of based on the circumstances that the taxpayer has gone through and what their current exposure is. So if, as a result of these webinars, this one tonight and prior ones, you realize that you have not been compliant, it's really, really important to act fast on these procedures and get back into compliance, assuming you are wanting to get back into compliance, as these procedures are typically a first to act procedure whereby you need to correct them before the IRS discovers it, as otherwise, if you are discovered, then you're ineligible for these amnesty programs. So if this is you, please reach out and we can discuss your case and what remediation path is most appropriate for your circumstances. But just want to reiterate that there is a way out. You're not, stuck, but this is a common thing. That's everything for me on this slide, James.
Great, man. We'll kick into a bit of Q&A as I've been lucky enough to receive quite a few questions before the actual webinar today. I think there was some that were unanswered from the last session, and then just I guess a few registrations that have come through asking the question. We do have a good one here, and I'll just address it right now from Lachlan, just around Social Security. Does the 10 years to qualify, can it be in separate stints of living in the US? Example, live there for 4 years, move to another country, and come back and live 6+ years. I mean, most of the time when you look at Social Security, it's taken over a 35-year period, your sort of working life based on your age. So yes, it can be different stints. I would say there'd be many people, even that remain in the US, that also just have career breaks that don't contribute much at all to the system for 1 or 2 years, especially if you are still on the exact same Social Security number. That's definitely an important one, just because I know that it's pretty rare you get another SSN given to you, but it really depends on how you've entered the US and then how you've exited. That's probably a caveat that I'll add to that, because there's a lot of different scenarios that we can run around that. And I hope, Lachlan, that addresses your question as best as I can there. Another one, mainly just a comment from Dennis saying most employers now offer Roth 401k accounts. I think I said my bit on Roths. Just be careful, be mindful around using those sort of things, just because it's just one of those, I guess you do just want to be careful. Obviously, you're not going to know what the future holds around when you're going to exit, or I suppose leave the US. So trying to, I suppose, target the best time to do so and withdraw those funds is always going to be difficult. A few more which I'll jump into. This is a good one. This is actually a really common misconception, which I think Jason and I still see doing around the Facebook groups, traps, those sort of things. I'm 55. I've been working in the US for 11 years, relocating back to Melbourne in January 2024. What's the best strategy for moving my 401k funds back to Australian super? So first and foremost, there is no ability to transfer from a 401k direct into an Australian super or Australian super fund. No one can do it. If they say they have, I want to guarantee they've lied. The reason for that is, first and foremost, on the Australian side, I guess the US pension system or retirement asset system It's not, I suppose, recognised under a QROPS, a Qualified Recognised Overseas Pension Scheme. They are very different tax vehicles. One is tax concessionally through your working life and then tax free. The other one is actually the opposite, not taxed and then taxed at your normal marginal tax rates upon withdrawal. So there is no easy way to transfer it straight into super. It's usually a case where it might be in your best interest to maybe keep it there until you actually are retired and then use it as an income supplement, part of your other retirement assets. Or, as you mentioned, you're 55, so you might be able to lean on what's called the rule of 55. Be able to access it early, but time is a key consideration there because you might want to try and reduce your or minimize taxes. So maybe waiting in a low income year might be best. But that's a really good scenario where I would seek some personal advice. Absolutely. That's one of those situations where you'll definitely need some advice. I've got one here, and it's mainly, I think it's going to be more of a question, absolutely for Jason. But I think there's probably going to be a few more context questions that you'll need, Jason. How is tax worked out if you are inheriting multiple Australian properties while living in the US? Very open-ended, that one, Jason. So I think there's probably a few other questions that you'll need to have
Yeah,
answered.
so I guess the first one is, are you receiving it from a non-US person, a non-US person being a person that is not a US citizen and not a green card holder and not a US tax resident at that point in time? Because if they're not a US person and you're receiving properties, knowing Australian properties, it's going to be worth over 100,000 US dollars, which means that you do need to declare the inheritance through Form 3520. It's just a disclosure. There's no tax calculation whatsoever on it. And then it's just a matter of which state you live in the US, is there inheritance tax or not? So those are the kinds of things you'd have to work through. Whether there's an inheritance tax, you can Google that based on your state. You'll be able to find out very quickly because it's obviously a pain point for Americans living in America.
Mm.
So those would be the bare minimums, what you would have to do.
Yeah, absolutely. And a good question here from Peter. And this would be very common for a lot of Australians, which were maybe forced out of the US briefly because of COVID and the whole visa thing and trying to get your visas renewed and all those sort of things. But if I was still working, if I was working remotely in Australia, but still being paid into US Social Security, so I would say still being paid by a US employer whilst being back in Australia, those you still count towards Social Security credits. They do. You're still paying into the Social Security tax system or through the US tax system. So you still are getting those credits for those years. They're not gone. And again, the big benefit around Social Security versus Australia's age pension system is it isn't assets tested. So it's not deemed tested, no deeming at all, which is great because it means you're still going to be eligible to receive that benefit once you get your 10 years or your 40 quarters. That's probably the main caveat there. This is another one that I've got. So let's have a look here. Being taxed on the gains of a 401k. If I've transferred many times, how would I ever find those records? Is there an estimation guideline? Oh, it's a good question. Once you've sort of moved around a few times. I mean, I've seen, it's a good question, Nick. Most of the accounts that I've seen try to pull that apart, they've actually requested years worth, like years and years worth of the history of the different 401ks to try and work out how it should be taxed. If they aren't successful, the next step that most, I think, Australian accountants would use would be seeking an ATO private ruling of how it should be taxed. And usually the type of private ruling that they might actually inquire for is what we call a UPP deduction. Can't remember the actual deduction line, it might be D11 or D13, I'm not sure. But that private ruling tells the accountant what small percentage of your income stream you can actually claim as a tax deduction. So if you're receiving, say, I don't know, 100,000 per year, just clean and simple, they might say, okay, well, you can use 10% as a deduction. So then you'll get a straight up $10,000 deduction in your tax return. So you're only paying tax on 90,000, which is assessable. That's probably the easiest way I can answer that one. But yes, usually they like to see some history of all the different 401ks just to try and work it all out. Otherwise, a private ruling will be best. And I guess moving into another question here, what sort of US retirement account should I set up for a 10-year stay in the US? Um, it really depends. I mean, if you're only going to be in the US for 10 years and you get the benefit of a standard 401k with your employer and a matching scheme, it's probably the best one I'd go with because it's just clean, simple, straightforward. I don't know your age, don't know, yeah, so not sure whether a Roth would make sense. It's rare that I recommend a Roth just because usually most expats, the year that they're actually leaving the US, they're not able to access them. So it's not really worth the benefit anymore. Um, I'll throw that one over to Jason. Good question, Lachlan. Do you guys work with people on tax equalization packages? Jason, have you come across those?
Yeah, so tax equalization, I'm assuming you refer to where the employer will pay you X amount more based on the fact that you're in a more punitive tax scheme to kind of make you whole. Is that what you mean by that, Lachlan?
While Lachlan answers that one, or comes back to us on that one. Oh, there he goes. He's quick. They tax us if we live in Australia. There we go.
Okay, so with the tax equalization scheme, we do offer that on the US side. I'm not sure if Ben would offer that on the Australian side, James.
Yeah, it's a really good question, Lachlan, because I'll say a lot of Australians, they are sent over to the US and they're equalised, so they're sort of taxed like they're in Australia, but they're not. But the employer just cops it and pays it on your behalf. Um, so, I mean, we do. Yep, we absolutely do. We work with people who are equalised, absolutely, and it's normally they're still treated as a non-resident for tax purposes. They've still got all the same problems. But they're just in a unique category. Usually those that are equalised often will get the benefit of their employer paying into an Australian super fund. And we call that a certificate of courage. It's rare, but there's a lot of clients that are in the US which still receive super guarantee contributions. And then when Jason's looking after their taxes, well, often those contributions need to obviously be taken into account when it comes to the US tax side. So it's those sort of things as well, intricacies. How do I become a client? Oh, Lachlan, great question. But often the best way is just to reach out. When you jump on Uptrend Advisory's website or Atlas Wealth's website, contact us via the online form is best. And then we just reach out and have a discovery call, learn what your situation is and how we might be able to assist. And then we just go from there. So that's generally the best process thereafter. Jade, good question from you. Let's have a look here. Is it true that your years worked in Australia count towards Social Security credits? It's a really good question. There is some, I guess, I don't want to say, you can get coverage if you are a US citizen and through the Social Security agreement that we do have in place with the US. So some years, yes, absolutely. You can use some years in Australia to get coverage in the US. I actually have a few clients that fall into that category where they're US citizens living and working in Australia. They're probably 5 years out from being able to actually access Social Security. But yes, they are getting some coverage from those years here, which is unique. But yeah, and it's a bit strange really when you consider that no taxes are actually being paid into the US system. But I guess it's just one of those little loopholes. I guess another question concerning exiting the US. Jason, when do you think is the best time to plan for, the exit tack or, if you're going to trigger the hard act? When should you start planning to try and avoid that event?
So, assuming this is a green card holder in that situation, then I typically advise clients to make your decision by year 6 of holding the green card. So that way you've got ample time to kind of plan the restructure of assets and everything like that, and make your decision. There shouldn't really be a reason why you wait much more than that, because at that point, surely are you going to become a US citizen or are you going to give up the green card? So that's generally why I recommend 6 years. And just to clarify how they count the years is, let's say it's December 31, 2023, and you get your green card on that day, that counts as a year towards those 8-year tests. So it could be 6 years and 2 days on either side of the calendars that make you trigger the exit tax tests. So make sure it's 6 years, and then at that point, start planning if you're going to give it up or keep it or move towards citizenship. But the exit tax really shouldn't be something you're caught by, surprise with.
100%, couldn't agree more there. And you do need to plan early. I've got clients that will be impacted, and they're implementing strategies right now to try and avoid it in a year or two's time. And it can even be using lifetime gifts and donations to family members where they'll get it back at some point, but they're doing it now to just lower their assets. There's a lot of creative strategy you can do. There's very large capital gain exemption as well in your worldwide assets, but as Jason has seen time and time again, it's often those assets we don't think about which take you over the line. It's things like an old main residence that you've left back in Australia that's accumulated and grown. It's an investment property now. Australian super fund, that's an asset. And then you factor in your 401ks and those sort of things. Surprisingly, you can actually, trigger and move over, I guess, that threshold very quickly. So plan accordingly and plan early. A good question here from Dennis. For an Aussie expat looking to retire in Australia, are there investments in Australia that are off limits, particularly considering dual citizenship? Dennis, absolutely. We jumped on that topic in our previous webinar. Jason talked about it, and the type of investment that you're talking about that I would assume, and I'm sure Jason will agree, would be PFICs, passive foreign investment companies. They're the ones which will catch you. But often we would obviously highly recommend, and Jason, I would assume you would highly recommend you avoid those ones.
Absolutely.
Yep. So they can be avoided. Typical definition of them, or just what they are in Australia, that's probably a lot easier actually. Any Australian domiciled ETF or exchange traded fund, Australian managed fund or mutual fund, listed investment company, real estate investment trust, those kind of structures should be off limits. And just because they are deemed to be a PFIC, passive foreign investment company, and that obviously creates a lot of reporting requirements and additional taxes in the US. So in Australia, focusing on your ASX blue chips, US domiciled ETFs and different fixed interest assets, you can still create yourself a terrific diversified portfolio, and that is something we do. But you just want to be mindful that you're not holding those kind of instruments or investments, because you'll have significant reporting requirements, and we've seen time and time again the big issues that they can create. So really good question there. I'll just give one more minute for some final questions, and then we'll wrap up for today's session. You would have seen the QR codes moving through as we did the Q&A, so that'll take you to our booking links online. That's the best way to get in contact with Jason, as we can see on the screen there, and us on the previous slide. We do have our social pages, which I'd highly recommend you jump in and follow. That is a really good area that we put out a lot of our articles and events that are happening. We'll both be having a big year. You'll see Jason, it's coming into US tax time, so you'll see Jason online a fair bit in the coming weeks. So I highly recommend you get to those sessions as he looks to just keep educating, because it is just a huge minefield when it comes to US taxes. It's always just one of those things that I'm very glad we don't operate in the US sometimes, given everything that you have to put in. And then on top of the state taxes, and that's a one that you mentioned before, Jason, where remember the ATO has a tax treaty with the US on a federal level. Doesn't mean we necessarily have a tax treaty on the state level. So it doesn't necessarily mean that state taxes can come across and be used as a foreign tax credit, and that's why you always have to be mindful around that. That actually looks like it was our last question for today. So ladies and gentlemen, we really appreciate you joining us on today's webinar. The recording will be made available in the next couple of days, and it'll be just going out to your emails. There'll be a copy of the slides as well. It is that time of the year that we are always about to switch off. Oh, we've got one last minute question, which I will try and answer. And you got in there just before the buzzer. I'll just throw this one out. So I am already drawing down on my US retirement account. Yep. It was a traditional annuity account that was tax deferred with only employment contributions that were limited. Is this income stream taxed in Australia when I return? So, yep. So it sounds like it's some sort of traditional retirement account. Might be because you haven't said 401k, it might be a 403b as an example, maybe, depending on your employer. Um, and you're drawing out an income stream from it, which would be taxed now. So yes, it will be taxed in Australia. Um, all US retirement accounts, when you're drawing out an income stream from them and you're an Australian tax resident, a portion or all of it could be taxable in terms of the income stream. So, and I would recommend you do get some tax advice around that. Depending on your status with the US, if you're a US citizen, or you're going to be a US tax resident, there are certainly some strategies that you can employ to reduce the maybe taxable income on the Australian side, but that's a conversation for another time. So based on that limited information, I would say yes, a portion of the income stream as a minimum would be taxed on the Australian side. When you lodge your Australian tax return, could be a transfer there of a foreign tax credit as well. That was probably the final questions there. In the meantime, guys, look out for the socials. We're putting a lot out, and I hope everyone has a lovely Christmas and holiday period. And we look forward to bringing you some more sessions in the new year. Thanks for your time. Jason, thanks for your time today.
Thank you. Thanks, James, and thank you everyone for joining.
Thanks, guys. Speak soon.